You know, the global tech supply chain? It's fracturing right now. And this isn't just some political headline. It's the single biggest structural shift happening in the global economy, and it's creating a massive, investable divergence right in the heart of Asia. We think by 2026, the winners and losers of this great migration are going to be crystal clear, and today, we're going to lay out exactly what that looks like.
So that brings us to this core idea we're talking about today, decoupling alpha. It's a strategy that's really built on a pretty simple reality. As US-China friction keeps reshuffling global manufacturing, some companies are going to get caught in the crossfire and face immense pressure. At the same time, others are perfectly positioned to capture this huge spillover of capital and opportunity. Our whole thesis is built on finding these two groups.
All right, let's start with the first half of this equation, the at-risk assets. We're talking about companies that are caught between tariffs, tech blockades, and this huge strategic push by the West to de-risk their supply chains. Okay, first on our list is China's semiconductor champion, SMIC. That's ticker 0981 on the Hong Kong Exchange. Now, the core problem here is something we're calling the legacy node trap. What does that mean? Well, SMIC is essentially cornered. They're cut off from the advanced chip-making tools they need for cutting-edge tech, which forces them to just keep churning out older, much less profitable chips.
And this is where the numbers really tell the story. So while SMX revenue was actually up in 2024, just look at this. Net profit collapsed by 45%. So why? It's because they're stuck competing in this crowded, low-margin domestic slugfest for older-gen chips. Their gross margin is squeezed down to 18%. And with 85% of their revenue coming from inside China, they have no high-margin outlet to the West. This is a company that's basically running in place.
And hey, don't just take our word for it. The really crucial point here is that SMIC itself is sounding the alarm. This quote, it's pulled right from their own filings. It's a direct admission of just how vulnerable they are. They know that their access to critical equipment, from companies like ASML, is under direct threat.
All right, let's pivot to our next at-risk candidate, Desay SV Automotive. They're a major auto electronics supplier, right out of the Pearl River Delta. And this is a classic case of a really successful exporter running smack into a geopolitical wall.
So get this, Desay SV had a phenomenal 2024. Their overseas orders just exploded, up 120%. But, and here's the catch, that very success is now on a collision course with a new 25% US tariff. So what happens? Western car makers are pushing for discounts, hitting their margins directly. And sure, they're building a new factory in Spain to help with market access, but that comes with much higher capital and labor costs, which just squeezes profitability from the other side.
Our final short idea takes us into logistics, COSCO shipping ports. Now, the risk here is a bit more gradual, but it's just as structural. You have to ask, what happens when the world's supply chains start to just bypass China's main gateways?
And this chart, it illustrates their vulnerability perfectly. Over 76% of COSCO's entire container volume flows through its terminals in China. So as global companies start adopting a China plus one strategy, diversifying with factories in Vietnam, Malaysia, Mexico, that heavy dependency becomes a massive headwind. The very trade lanes that COSCO dominates are the ones most exposed to being rerouted.
So that brings us to the other side of this great divergence. As all this capital, this technology, this manufacturing, as it flees the pressures we're seeing in North Asia, where's it all going? Well, it's being deliberately reinvested south and east, creating this incredible corridor of opportunity that stretches all the way from ASEAN up to Japan.
So, let's meet the alpha gainers, the companies that are directly benefiting from this historic shift. We're going to focus on 3 key hubs that are just perfectly poised to capture the spillover: Malaysia, Japan, and that Singapore-Johor corridor.
I mean, the scale of this migration is just staggering. Take the German chipmaker Infineon. They're pouring an additional 5 billion euros into their facility in Malaysia. Why? To build the world's largest factory for a new kind of power semiconductor called silicon carbide, or SiC. These chips are absolutely critical for EVs and green energy because they're way more efficient at handling high power. This isn't some small bet. This is a multi-decade commitment to a brand new manufacturing hub.
So who's winning from this gold rush? Well, it's the companies providing the picks and shovels in Malaysia's booming semiconductor testing and packaging sector. We see 2 key players here. First, you've got Inari and Ameritron. They specialize in testing radio frequency modules. As US tech giants shift this critical work out of China, Inari is just perfectly positioned to catch that volume. Then there's Vitrox. They sell the essential inspection equipment for every single new assembly line, making them a pure play on all this new capital spending. And you'll want to keep an eye on smaller players like Globotronics too, as this whole ecosystem expands.
Okay, let's hop over to Japan. This timeline for the component maker Rohm, ticker 6963 in Tokyo is, well, it's just incredible. They are a leader in those critical silicon carbide power chips, and just look at these expansion plans. A 35-fold increase in capacity by 2030. That's not a typo. 35 times. This is a company going all in to supply the fundamental building blocks for the entire global EV and green energy transition. It's also a really interesting contrast to peers like Renesas, which are pivoting to a more asset-light model. This makes Rohm a much more concentrated bet on this manufacturing build-out, which in turn benefits giants like Tokyo Electron, who supply the gear for these new lines.
And for our final pillar, let's zoom in on this incredible nexus that's forming between Singapore and Johor, Malaysia. The absolutely insatiable demand for artificial intelligence is creating this unique cross-border infrastructure boom.
And what it creates is this powerful, self-reinforcing cycle that we call the AI infra flywheel. Think about it. Step 1, AI drives massive demand for data centers, which is Keppel DC Reach bread and butter. Step 2, these data centers are incredibly power-hungry, and they need green energy to be sustainable. Well, that's where SimCorp Industries comes in. They're massively expanding their renewable capacity specifically to power this digital boom. It's a perfect, symbiotic relationship, and it's all being driven by the AI revolution.
Okay, so let's pull back for a second. Let's look at the macro view. Is this whole thesis actually supported by the big picture data? And, maybe more importantly, what are the major risks we need to be watching? Well, the evidence is pretty compelling. And it's not just Western capital that's on the move. Just look at the flow of Chinese manufacturing foreign direct investment into the ASEAN region. It nearly tripled between 2017 and 2023. I mean, this is the ultimate validation of the thesis, right? Even Chinese firms themselves are diversifying production to get around tariffs and supply chain risks.
And this, right here, is where the opportunity lies for investors, the valuation gap. We believe the market just has not yet fully priced in the sheer scale and permanence of this shift. A lot of these beneficiary stocks in Malaysia, Singapore, and Japan are still trading at a discount to their global peers, even though they have a much, much stronger geopolitical tailwind.
But, no thesis is without its risks. And the big one here is China's countermove, its control over critical resources. Through export controls on materials like rare earths and graphite, Beijing can significantly raise costs for all these new factories. This is, without a doubt, the primary risk to our thesis. But here's the paradox. Every time China uses this leverage, it just reinforces the strategic urgency for Western companies to secure non-Chinese supply chains, which, in the long run, makes this migration even more inevitable.
So, how do we put all of this together? What's the actionable investment framework for 2026?
This table, really? It's the whole story in one place. You can almost think of these as a series of Paris trades. For every single geopolitical pressure, there's a company at risk and a company that's set to gain. The tech blockade hurts SMIC, but it benefits Rohm. The tariff squeeze hits Desay SV, but it creates this huge opportunity for Inari and Vitrox. And as trade reroutes away from COSCO's ports, the new digital and green infrastructure being built by Keppel and SemCorp thrives.
So, we've laid out the landscape as we see it for 2026. But if there's one constant, it's change. The very same realignment that's creating these opportunities today will inevitably create new dependencies and new vulnerabilities tomorrow. So the question we should all be asking ourselves is this: what's the next choke point?